Hello folks, Happy New Year. Today I'm going to talk about investing in international markets through the mutual fund route, how the past few years have been for this space and what you could possibly do in the future. Now, Indian investors got really invested in the international market post-COVID, especially in the US markets. One of my friends caught this trend early on and suggested that I also look into it. I did my research and found that yes, US markets did look promising, especially in the technology related stocks. I also did my research in other regions such as China, Europe, Australia, and EMEA. Out of this, China stood out simply because it is A, the second largest economy in the world, and B, because it had a swift recovery from lockdown. So at that time, I invested in two US based funds, which are looking at technology stocks, one large cap China fund, and also my India funds, the investments continued there. How have these funds fared currently? So if you are a lump sum investor who entered between April 2020 and October 2020, then your investment in India related funds would have fared the best because the market has gone up steadily and is currently at the all-time highest. Your second best investment would have been the US fund because as you can see, it went up, it dipped down again, and then it has recovered well. Whereas if you'd have invested in the China fund, your investment would be probably flat or negative at this point of time. But if you are an SIP investor who is investing in international funds, and you would have needed a lot of courage to stay invested in these funds, your investment in the US funds would have done the best because you would have got the dip early on in April 2020 to October 2020. It went up to October 2021 and then came down again. So there again you would have caught the dip and reduced your cost price, and now markets have recovered again. Your second best investment would have been the India fund, but in China it would have been largely negative returns which have been generated. So my personal portfolio, when I was going to invest in at that time, I had got a lot of responses from knowledgeable sources saying that China markets are opaque, the news doesn't come out clearly, so to avoid it. But I wanted to gain some insights into international markets and I just didn't want to diversify into the US alone. So I put some money into the China fund as well. But where I put 80% of my money in the India related funds, I put 15% in US funds and only 5% in China. So because the risk was more, I had limited my overall exposure to international funds to 20%, and within that I gave only 5% exposure to the China fund. 3 years later, now I'm exiting the fund because I've made losses, which is part of the game, but also because I don't see a quick recovery from China market. This is largely due to the tough government intervention over corporates and also the ongoing US and China trade war. Many of the corporates which are US based are now diversifying. They are looking at India as an option for manufacturing as well as other countries. So this has made me feel that it's better to pull out my money and probably invest it in India or in the US space again. However, I'm glad that I did this exercise because it helped me to gain insights. It helped me to realize the power of diversification. Whatever money I'm making, I'm losing in the China fund has more than been offset by my gains in the US funds. So I would continue with this strategy. I do think it will pay off in the long term. So to summarize, when you're investing in international funds, it is good to limit it to a small part of your portfolio to keep constant reviews and ensure that you time your exit well from these funds. If you have any queries or comments, do drop it or send us a message on our contact points and we'll be happy to get back to you. Thanks for watching.